Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NMI Holdings INC quarterly report. NMI Holdings Inc. offers a range of services to the financial industry, including private mortgage guarantee insurance, primary mortgage insurance services, outsourced loan review services for mortgage loan originators. The company serves various types of lenders, such as national and regional mortgage banks, money center banks, credit unions, community banks, build-your-own mortgage lenders, internet-sourced lenders, non-bank lenders. NMI Holdings Inc. stock price drop. A broader sector shift in the past year. NMI Holdings Inc.'s NMIH stock price experienced a notable drop of 6.24%. This decline was largely attributed to broader shifts within the financial sector and increased cautious investor sentiment. The company's steady business execution and resilience in the mortgage insurance market did not contribute to the decline. Factors contributing to the broader decline included potential future pressures such as rising defaults, competitive actions like repricing and underwriting changes, and a growing debt burden. However, the company's third quarter 2025 earnings surpassed estimates, leading to a modest stock increase in aftermarket trading. This suggests that the significant drops occurred prior to or independently of these positive earnings announcements. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth is primarily driven by an increase in net premiums earned, net investment income, and the issuance of master policies with a significant number of customers. The company's primary insurance in force has also grown to $218.4 billion, while its high-quality insured portfolio has increased. Additionally, the company has seen growth in customer franchise and market presence, as well as an increase in penetration of existing customer accounts and new customer activations. On the other hand, revenue decline is primarily driven by the runoff of in-force policies, faster speeds of mortgage prepayment leading to lower persistency rates, and cancellations, principal repayments, and other reductions. The company has also seen an increase in newly defaulted loans, leading to higher insurance claims and claim expenses. Overall, the company's revenue growth is largely driven by its ability to attract new customers and retain existing ones, while its revenue decline is primarily due to the runoff of in-force policies and changes in customer behavior. Net income and profit margins. A changing landscape, the financial performance of a company has undergone significant fluctuations over the past 2 years. Net income has experienced an increase of 7.6% from 2023 to 2024, reaching $20,770. However, this trend was short-lived, as net income decreased by 3% for the 9 months ended September 30, 2025. Profit margins have also undergone changes. The combined ratio improved significantly, decreasing from 31.5% to 27.5%, a 10% improvement. On the other hand, net income margin experienced a slight decrease, dropping from 56.4% in 2024 to 56.1% in 2025. The reasons behind these changes are multifaceted and not explicitly stated. However, possible factors include changes in statutory contingency, reserves treatment, higher persistency rates, growth in customer franchise and market presence, and the exclusion of non-operating items. Despite these fluctuations, the company's financial performance remains a subject of interest for investors and stakeholders alike. The company is generating positive operating cash flow, as evident from the consistent net cash provided by operating activities over the past 2 years. In 2023, the company generated $357,783 in net cash, while in 2024 it increased to $357,556. This indicates a stable and increasing trend of positive operating cash flow, suggesting that the company is effectively managing its operations and generating sufficient funds from its core business activities. The company's debt level and interest expenses have undergone significant changes. The total debt has increased by 13.6% from December 31, 2024 to September 30, 2025, reaching $3,145,999. However, there is a discrepancy in the unamortized debt issuance costs and original issue discount, which decreased from $9.9 million to $8.5 million. On the other hand, interest expenses have shown a decline. According to various pages, interest expense decreased by 28% for the 9 months ended September 30, 2025 compared to 2024, with specific decreases of $48,000, 1%, and $8,449, minus 28%. These changes indicate that while the company's debt level has increased, its interest expenses have actually decreased. Management is optimistic about the company's outlook, citing plans to expand its customer base and grow its insured portfolio of high-quality residential loans. They aim to build on their position in the private mortgage insurance market by focusing on long-term customer relationships, disciplined risk selection and pricing, fair claim payment practices, responsive customer service, and financial strength and profitability. However, management is also cautious about potential macroeconomic factors that could impact the housing market and business, such as inflation, interest rates, consumer confidence, and jobless claims. They are taking steps to mitigate these risks through their Rate GPS program, which helps maintain a high-quality mortgage insurance portfolio. In terms of financial performance, management notes that profitability can be impacted by prepayment speeds, persistency rates, and policy mix. They also expect to continue evaluating reinsurance opportunities to manage risk. Overall, the company is focused on maintaining sufficient liquidity to meet its corporate expenses, interest payments, tax payments, capital support for subsidiaries, stock repurchases, and dividend payments. Management is committed to managing market risk through a defined investment policy and monitoring key drivers such as interest rates, term structure, and credit quality. The company has demonstrated its commitment to returning value to shareholders through two key initiatives, dividend payments and share buybacks. In June 2025, the company paid out $98.4 million in dividends, providing a direct return on investment for shareholders. Additionally, the company repurchased 2 million shares at a total cost of $73.7 million, reducing the outstanding share count and increasing earnings per share. That concludes the financial summary for NMI Holdings INC. Feel free to comment below, and I will be happy to answer them when possible.